Trying to understand the eminence of real-world assets and the DeFi world? Then you are welcome to Link to the Chain, a podcast brought to you by Vsauce. It is designed to help you understand the happenings of decentralized finance along with real-world assets. I am your host, Nikki from Vsauce. I will be inviting experts from the Web3 industry to share with you their experiences and ideologies on RWAs and the DeFi world. Hey everyone, today I'm pleased to be joined by Joe Foster. He's the head of product over at Cred Protocol. So, Joe, thank you for spending some time with us today. We really appreciate it, us here, the team at Vsauce. So, kind of just give us a rundown. Can you share with the audience or listeners who you are, what you do, and how did you get into the DeFi space?
Hey Nikki, so Joe Foster at Cred Protocol here. I joined Cred 8 months ago, and I am responsible for everything we do across credit scoring and our other credit products, so credit reporting, credit monitoring. Um, my background was in traditional finance in credit. I worked for a bank for 5 years doing kind of classic large corporate credit underwriting and structuring. And then I joined a VC company who was doing unsecured lending to early stage startups. And so that really got me kind of deep into the weeds of how do you use real time open banking data to assess risk and make loans. Um, and my fund was beginning to look at Web3. It was kind of during that period of time where everyone from the TradFi world was clambering aboard Web3 as prices were rising, valuations were rising. And it really got me interested in what does the Web3 lending market look like. And I came across Cred Protocol because at the time, and kind of even today, they're really one of one or two players who are doing a really good job of trying to apply some of those learnings that we've had in traditional finance over kind of centuries into what is a very new and different market in Web3 lending. And so I began chatting to the founder, Julian Gay, and a few months later, I agreed to join his merry band of 4 or 5. And today we are at 10 people with a number of customers, and we've just passed servicing 100,000 scoring requests. So we're well on the way on the journey, but sort of still much ground to cover.
Wow, that was pretty thick information. No, that's good. That's good. Thank you for providing all of that knowledge. Wow. Yeah, that sounds like you've really got yourself with your plate full, but also exciting. What would you say, in your own words, is credit scoring? And can you enlighten our listeners with information about credit score and why it's important to kind of be aware of?
Yeah, so I think a good place to start is what is credit scoring in traditional finance? Like you and I both have a credit score, be it with Experian or FICO or Equifax. And really what your credit score is a number that quantifies your riskiness. And so what that is it's taking a look at all of the previous behavior you've done, be it with lending products, either your mortgage or your credit card, and giving a kind of a future view of how likely you are to pay back your next loan or your next obligation that you have. And typically a credit score looks at that over like a given time period. So it might be if you take out a loan today, what's the probability of you defaulting on that loan in the next 90 days? And the reason why that's really important is it's when you go to the bank or when you go to a fintech and you're asking for some money, it's giving people the opportunity to kind of demonstrate and leverage their previous good behavior to access financial products and services. It's basically saying that every time you take out a new loan, it's not the first time and your previous behavior counts for something. And what it might count for is a higher loan or a better structure or better price or kind of like less onerous security requirements. And I think what's really important there is it kind of opens up access to credit for people. Like credit can be such a powerful thing in terms of like building people's lives. Like taking out that first mortgage is a massive point in someone's life. And in traditional finance, people heavily believe that all of the previous behavior you've had up until that point should count for something for that like big life decision, and you should be rewarded for the good behavior you've had, but then also penalized if you have had previous bad behavior.
Right. It's definitely something we use in our everyday lives, from when you're buying a car, when you're trying to get a house, all the big real world assets, right?
Yeah, and I think it's something that increasingly as well, like the education piece is really important because I think we banks are using credit scoring every single time they're making a decision about your financial future. And so it's only right and reasonable that they should be very transparent with you that firstly that they're doing that, but then also what can you do to make that score better? So like, are we teaching teenagers that actually like taking out a credit card or paying your Netflix bill is really, really important because of the consequences that it might have on your like financial independence in the future. So I think something that's really nice at the moment is like the amount of transparency and the amount of education that's happening in order to give people awareness of the importance of credit scoring and the impact it can have on people's lives, and also what is in their power to do to make it better so that they don't get any nasty surprises.
Yeah, I think it makes a lot of sense, even with people who are just, average Joes who may not be into NFTs, crypto, blockchain, DeFi. And I think it is a great topic to kind of teach in school. If we were taught maybe in high school or even in middle school, like you said, it's pertinent information to know, even as little as paying your Netflix bill on time, paying your cell phone bill on time, because those do have consequences, right, in the future. If you don't pay your, loan monthly mortgage every month, then you end up paying more in the long run because of interest. And I don't think everybody really gets the opportunity to learn those like simple, basic life steps at a young age. It's kind of like, oh, you graduated high school, you're in college now. Oh, you're still living with your parents. And then once you get out of college, you're kind of like, oh, bills? What are bills? So, I mean, at least in America, I feel like we definitely need a lot more financial education. So it's kind of good that we're in a day and age where we have technology now. You can listen to podcasts like this. You can go on YouTube. You can do a quick internet search. So, yeah, thank you for breaking that simple yet complex ideation down. Well, moving on, why is the feature of credit scoring important for onboarding real world assets like cars or real estate into the DeFi world?
Yeah, and I think this kind of speaks to the stage that credit scoring is at, or even just the understanding of risk is at in DeFi. I think so far we've kind of talked about how well embedded the idea of credit scoring is in traditional finance, and none of that really exists in DeFi yet. And so the reason why credit scoring is important in DeFi is because it brings like trust and transparency to reputation and lending. And I think if anything has been made clear over the last kind of 12 months in the world of crypto and DeFi, it's that trust and transparency is absolutely needed, and that people's understanding of it and embedding it in their business is just of paramount importance. And I think DeFi, given this kind of like transparent infrastructure, has the opportunity to bring that trust and transparency, and I think credit scoring is a big part of that. And so I think in the same way as traditional credit scoring, we need to find a way of actively rewarding good activity and good behavior and penalizing bad activity and bad behavior. And at the moment, what you have in DeFi is that the majority of loans are blindly over collateralized and priced, and all users are required to post more collateral than the loan amount, and they're all charged the same. And I think to bring that notion of allowing for differentiation of like loan applicants by risk, you then open up the ability to differentiate loan sizing, collateral amounts, and pricing based on their riskiness. And so to the point you made first, it's like, yes, of course, your future, your previous behavior should impact your future ability, your future access to product. And I think that's why credit scoring is really important in DeFi. And I think one of the reasons why RWAs and off-chain data is so interesting to DeFi is that it allows for kind of even greater accuracy in differentiating that risk and bringing even greater levels of transparency. So that's one of the reasons that we're so excited about real world assets, is because there's such a rich pool of data that's well understood that if we can bring into the DeFi world to supplement the data that exists in DeFi, what we're really going to be doing is giving this like holistic risk perspective that gives people the best opportunity to demonstrate their creditworthiness.
Yeah, I agree 1,000%. I think if more and more people are educated on the matter, as well as, like you said, more trust and transparency is brought to the industry, I think average people, regular folks, consider actually spending even more and adding to the economy if they are able to trust. Because, when you go out and buy a car or a house or whatever other real world asset, sometimes when you're purchasing a huge amount, you do have a little bit of buyer's remorse sometimes because the salesperson could be really pushy or they could be just super pressure, putting a lot of pressure on you, and you feel inclined to just say yes, and then you have buyer's remorse. So I think a lot of people, if they have the knowledge, they're equipped with that, they would actually trust getting into DeFi more, trust getting into the blockchain technology wave, and like I said, adding to the economy. Do you agree with that, or do you think there's more factors involved?
I also think probably the biggest one is if you're getting into DeFi, let's say you've just opened up your first wallet, and at the moment, if you've just opened up your first wallet and you go to a lending protocol and you want to borrow, let's say, $1,000, what the lending protocol will ask you to do is put up 1,400 or let's say $1,500 of collateral. And so even to engage in the DeFi lending system, you need to have more money than the money that you want. And that already just massively restricts the pool of people who have access to credit in DeFi. And that kind of like really sits at a counter to what DeFi should be all about, which is it's this kind of like decentralized place in which all are treated fairly and equally and all have like access of opportunity without like the need for intermediaries. I think one of the things that bringing real world assets in is it means that when a new DeFi user begins their journey in DeFi, they're not starting from scratch. They have the opportunity to bring in this kind of like rich history that they bring from traditional finance. And so rather than it being a wallet that's not got any transactions, it's a wallet that's not got any transactions, but accompanied by a human being that has a rich credit history coming before. And so when they go to that first lending protocol, rather than having to put up $140, $160 to borrow 100, that they're given terms that reflect like their credit worthiness as an individual. And I think what that will do is drive greater adoption. That will drive greater trust in DeFi as like a viable alternative or a viable option compared to traditional finance. And that can only be a good thing.
Yep, definitely. And circling back to credit score, what parameters determine a user's score? Like, can you walk us through a few parameters that contribute to the credit scoring with highlighting which parameters focused on as RWAs are the hot topic right now?
Yeah, of course. So I think that the primary and obvious one, which we kind of hold as the highest weighting, is borrowing history. And so that's basically just what has been your previous borrowing history? How much have you borrowed? How many times have you borrowed? When did you borrow? And did you pay that back? That's kind of like the thing that most directly correlates to your future ability to repay loans is did you pay back your loans previously? But the second one, and probably the one which links most heavily to RWAs, is account composition. And so within that, we really mean like what's the asset breakdown within your account. And so in DeFi, that would be what are the tokens you hold in your wallet? What are the NFTs you've got in your wallet? What's the balance of your wallet? And what that tells us is what's your affordability? So how much have you got and how much can you afford to pay back? And I think one of the things that RWAs do is they bring in this extra pool of affordability. So it tells us, okay, where are your assets both on chain and off chain? And what's the whole picture here? Because if you've only got a very small percentage of your assets on chain, if we only looked at the on chain data, we might think that your affordability was very low. But suddenly, if you attach that on chain data with off chain, where you hold the majority of your assets, actually your affordability looks very high. and your access to products on chain then becomes much, much greater. So I think that's probably the major way in which RWAs would interact with the kind of the traditional factors that go into a user score. But we also look at the way in which a wallet interacts with the ecosystem. So what's the kind of size and volume of activity with an account? How many transactions are you making? How big are those transactions? What protocols are you interacting with? Are you interacting with blue chip protocols with great reputations? Or are you kind of interacting with the murkier side of DeFi? And again, would make like a risk assessment about what does your behavior and activity on chain tell us about what kind of individual you are and what kind of behavior we might expect if you were to get a loan. And then maybe the final one I'll touch on is something that we call trust and transparency. So that's like things within our credit score that link to trust and transparency. And the reason why I think RWAs have a role to play here is credit scoring in pure DeFi is interesting because the data is not user permissioned. It's on chain, anyone can see it all the time, and it's live and rolling. So we don't have to request a user's permission to give them a credit score. With RWAs, providing that data to us is likely to be user permission. So an individual that's wanting to get credit scored on the basis of their on-chain and off-chain data is likely to have to say, yes, this is me in some form. It could be pseudonymously, or it could be explicitly saying, yes, this is Joe Foster who lives in England and blah, blah, blah. But that kind of link between reputation, identity, and credit scoring is really important. And so we think that an individual who is giving a credit scoring business or a lending protocol access to their RWA information is likely to be more creditworthy because they're willing to give access to sort of like greater pools of data.
Yeah, I've always thought if you can be one thing, be efficient. And it's actually a quote from this like Canadian comedy show I love. It's called Letterkenny. So for any Letterkenny fans out there, that's my favorite quote. But it's true. I think, especially with this type of tech, you have to be as efficient as possible. I think that it's saving time and you're able to accomplish more, right? When you have a little bit more time. And you don't have to sift through all that data when it's being presented to you through analytics, through different software platforms, etc. And it is a lot to take into account, right, for finance department to take a look at all these different credit factors and think, okay, are we going to approve them or not? How much, how low, how high? So, I mean, with this tech, I can't help but think, is AI technology somehow really useful in this type of situation?
At the moment, we don't use AI in particular, but what we do focus on is, as you say, like the streamlining of that data ingestion place. And what there are is great businesses out there who provide on-chain and off-chain data in real time that can be really easily ingested and interpreted. And so what we do is we partner with those people and then run machine learning models on top of that data in order to come out with these scores. And I think the focus on making as much data available to people as easily as possible is really important, both on the business side, but then also playing insights back to consumers too. To kind of pick up on a point you made at the top about the education piece, if we have all of this data on you, or if you're providing all of this data to a credit scoring business, what can that credit scoring business do to give insights about your behavior back to you? And I think like you can see this sometimes in the traditional finance world. If you go into your banking app and it tells you this is the percentage of all of your outgoings this month you spent on going to the shops, this is what you spent on entertainment, going to the cinema, this is what you spent on holidays, that then tells you about like where your money is going, and it allows you to make smart choices about where you could either cut expense if you needed to, or things you maybe didn't like. When you're sitting there at the end of the month going, where's all the money gone, it actually allows you to kind of like trace back every step you made the month, and lets you know about your own behavior, things you've maybe missed. And I think that's something again which would be super helpful in DeFi, because it's a mad world where you might have multiple wallets across multiple protocols across multiple chains, and it's really easy to just to lose track of where you keep all your assets and what you do with them. And so I think something that we try and do is, for every bit of data we ingest, we try and keep the ability to play it back to our customers. So we've got a DApp, a decentralized application that you can connect your wallet, and you can see in your own credit report exactly where you've all your assets are, exactly where they were last month and the month before. And I think that kind of like that is only enabled by having really high quality data ingestion, and by us working with partners who are best in class at kind of cleaning and aggregating on-chain and off-chain data.
Oh my God, yeah. I love a good organized list. I don't know who doesn't appreciate a good breakdown about where all your assets are, what you've been spending on. And I think bringing self awareness to, yeah, your spending habits, even daily life like groceries, gas, movies, like you said, holidays. I think it's important that we as humans are more aware about where we're putting our money. So, can we dive a little bit deeper about how, credit scoring requires a holistic view of a user's on-chain risk? How does that integration of information from various sources take place?
Yeah. So one of the aims of our score is to be universal. So we want the score to be able to apply to as many accounts as possible. And one of the reasons we have that aim is because we want to reduce the population of credit invisible people. And you hear that term quite a lot in traditional finance about immigrants, people newly in countries, about young people trying to get access to credit. The bar for getting a credit score in traditional finance is really quite high. And so we want to reduce that. And so what we want to be able to do is produce a predictive score from as few data points as possible, so that people with limited transaction histories are not penalized. Having said that, we also believe that a user should be rewarded for giving access to as many data points as possible to inform this kind of holistic score you talked about. So is that giving us access to as many wallets as possible? Is that giving access to open banking or real world asset information? So the way that our score works is it's the product of a large number of features. And these features can be specific to specific data sources. So that might be on-chain number of transactions, length of your accounts, like lifetime, or it could be like amount you've borrowed ever, or it could be linked to kind of an aggregation of all of those data sources. So it could be total transactions across your bank accounts, your DeFi wallets. And so because it's a product of the large number of those factors, if you add an additional source of information, what it will do is boost all of those features associated with that particular bit of data you've given us, and also boost all of those aggregate features which are looking across multiple data points. And so what that would mean there is basically, in general, if your data is good for the data source you've connected, you are going to get a better score. So we're kind of incentivizing the giving of more data across multiple platforms in order for you to achieve a higher score.
And are there any off chain information that gets integrated into the derivation of the credit score?
Yeah, so at the moment we have the ability to ingest open banking information. So that would be the kind of inflows and outflows from your day-to-day spending cards. And we have the ability to join that with the information that we receive from your DeFi wallet. And so we're always looking for we're greedy for data, and we're always looking for like new places to find credit signal. And so at the moment it's open banking, but in the future we're also going to look at things like transactions you might have in like a brokerage account, like, or a centralized exchange, or even maybe traditional credit scoring information.
Wow. Yep, it's a lot. It's definitely a heavy subject, but I think it's important for everyone to, be aware and understand early on so we can drive that adoptability so much faster once it really lifts off again. So, since the account composition, which features linked to the asset breakdown within an account is a credit factor? And then, what's the importance of real world asset possession in comparison to other assets?
Yeah, so I think the main thing, well, there's maybe three reasons why real world assets break down nicely into kind of account composition. One is length of time. So DeFi's only been around in a big way for maybe 4 or 5 years, and actually, like the majority of users have maybe only joined in the last three. And so the length of time that we have to look over it is very short in the grand scheme of things in DeFi. But with real world assets, it might be that you're 40 years old now. So we've got maybe 25 years of real world asset history. So I think what is nice is that people can, kind of, as I mentioned earlier, start their DeFi journey on the back of their traditional finance journey. And so when they bring their real world asset data, and they join it with their on-chain data, they're not just giving 5 years of data, they're actually giving 25. So I think that's a hugely valuable thing for why we should be considering real world assets. I think there's also the proportion of assets. I think if you look at the average DeFi user, they've probably got only a fraction of their assets on chain. So like maybe you've got a couple of £1,000 sitting in a DeFi wallet, but you've got a house. And so I think one of the other things is that if we bring in real world assets, we have this idea of like the whole picture across every single asset they've got. And then I think also the point I mentioned earlier about identity. So real world assets tend to be linked to physical identity in a way that a DeFi transaction inherently isn't. So this bridging of identity in Web 2 and Web 3 is a nascent field, and I think people are still feeling out the various options that you can have when sort of bridging Web 2 and Web 3 identity. But I also think that there's definitely something in this idea that if you're willing to bring your physical identity with your real world asset on chain, then that needs to say something about your ability to repay debt.
So to recap, you feel like there are three reasons, and they would be length of time, proportion of assets, and the link to identity. Yeah, those are three really good examples that I think a lot of folks should definitely take into account. And with the link to identity, do you think that also coincides with digital ID? Do you feel that the government is going to include all that information, like all the stuff on your passport, driver's license, into the kind of car you drive, what type of insurance you have, what type of house you have, how long have you, do you think it's going to be together, or will they be kind of separate?
DeFi answer to that question is that I think people are going to get a lot of choice. We have worked with a number of protocols that span like the whole spectrum of identity, from soulbound, so soulbound identity, whereby you're not linked to your real world identity at all, but you have this idea that you create a single place for your Web3 reputation, to which you can attach anything like your credit score or membership of a DAO or something like that. So you have like a very solid Web3 identity that sits separately from your Web2 identity, to protocols that join Web3 and Web2 identity. So you could have like a passport to which you mint a credential for your Web3 credit score, but you could then also mint a credential for your Web2 FICO credit score. So although it's being hosted on a DeFi platform, you've linked your Web3 and your Web2 activity to fully pseudonymous. You're sort of like only ever using your Discord handle name. You're only ever using a DeFi wallet, and there's really no way for any person, lending platform, or cred protocol to know who you are in the real world. So I think like in DeFi, and I think this is great, is that you're going to have the opportunity to choose. I think the the opposite can be said for TradFi, is that like I'm in the UK, and I think your options are going to be very limited as to whatever the government decides. And I think particularly in the credit scoring space, the way in which you use people's private information, the way in which identity is linked is very explicit. And then it's up to businesses to interpret whatever the government says, and there's not very much choice about that. So I think like the regulation side is something that we're watching very closely, particularly as you say, as in the US, as this becomes higher up the radar for lawmakers. And so yeah, it's whenever we hear there's Senate hearings going on, certainly we've got the news page open on our laptop.
You got to stay ready because you never know, right? Well, with time being of the essence, I do have one more question for you, Joe. And With RWAs being the talk of the DeFi world and a high demand to increase its functionality on chain, what is Cred Protocol doing or supporting to smooth that onboarding process of RWAs onto the chain?
Yeah, and it's something that we're really excited about. And so I guess the first thing that we're trying to do is and I guess talking to people like Bezos and others is to make sure that we're in the conversation. So there are people doing very, very innovative things, and we just want to be part of those conversations with lending platforms that are using RWAs at the moment or plan to in the future, um, and then making sure that we're ready to implement whatever solution becomes relevant for them. And so in the background, that means working with the necessary off-chain or on-chain data providers to reliably ingest RWA data if it sits off-chain or when it's brought on-chain to make sure that we have the ability to understand and interpret it. So that would be kind of like where are we going to get the data from? But then we also need to test features in our score to make sure that the RWA data is actually improving our models and better capturing risk. There's no point in us just looking at the data if it's not actually making our scores any better, because then we're not really providing utility to our customers. So again, we're doing a piece of work about, okay, now that all this data exists, how do we kind of get signal from all the noise? There's so many things we could put in the score. What are going to be the things that are most impactful? And then the final one is actively exploring pilots. I think what we would really love to do is to find a couple of partners where we could say, hey, look, here is a score based on-chain or off-chain RWA data that's being collected by this platform. We're partnering with them to give them a credit score, and here's the utility it's providing. I think that's one of the things in the DeFi space that's most powerful is when someone sees it working once somewhere, it tends to get copied multiple times very quickly. And so I think what probably the best thing that the ecosystem can do is to get a pilot where you've got a credit score being applied on-chain RWA data to give people actual utility. And I think people would see that, find it very exciting, and then very quickly you'd see a whole host more projects.
Very true. I know that to be a great salesperson, you have to come with a dramatic demonstration, and proving that utility is definitely a dramatic demonstration. So, big ups to you, Joe, and everything that you're doing in the team at Cred Protocol. It's been wonderful getting to know you, getting to know more about what you guys do at Cred Protocol, and just thank you for your time and dropping all this free knowledge for the audience and our listeners. Can you plug yourself real quick and just tell everybody where can they learn more about you, about Cred Protocol, and if you guys are working on anything exciting at the moment?
Yeah, of course. So we are on Twitter, Discord, and we've also got our website. So on Twitter, we are cred_protocol, or we're www.credprotocol.com. Our focus at the moment is on being able to ingest as many lending protocols as possible. So I think in the coming weeks, you'll see a series of announcements about new lending protocols that we cover. And we're also focused on growing cross-chain. So previously, we've been focused mainly on Ethereum, but with the rise of the L2s, we're again, over the next couple of weeks, you'll see a number of announcements about our ability to cover other chains. And then also working with traditional fintechs is a big focus for us at the moment. We'd love to give people the opportunity to leverage their crypto data when getting traditional loans. We think that's really important, particularly for parts of the population, maybe like early 20s, late teens, where they've been using crypto for years and years and are maybe struggling to get their first credit card or getting a first credit card on rubbish terms because that credit card company is not looking at their crypto data. So again, we think that there's a lot of power in that. So yeah, we're also beginning to expand our network in the fintech world. So watch that space.
Sweet. Yes, you guys are setting the foundation, and I'm here for it. Well, thank you again, Joe. And I can't wait to see what else Cred Protocol achieves in the next few months. And yeah, thank you again for spending a few moments of your time with us today.
Thanks for having me. It's been great.
You're welcome. With this, we come to the end of the episode. To our audience, thank you for listening. If you enjoyed what we are discussing about the RWA and DeFi world, please don't forget to subscribe to Link to the Chain and share it with others. To catch all the latest from us, you can follow our Instagram and Twitter at Link to the Chain. Looking forward to sharing with you guys the next episode. Stay tuned.